Well, I'm going to go ahead and get started. So, welcome, partner agents, and thank you for joining us to learn more about the HECM for Purchase Loan Program. We wanted to give you a short presentation on what the program is and how to use it, and then open the floor to questions at the end. So, if you all could hold off on questions until the end, that would greatly be appreciated. We'll allow you guys to unmute yourself and ask Laura and Mary Lynn more questions about what they do and how they do it. But before we get into our session, I would like to introduce to you the two ladies who are on this panel with myself. Mary Lynn Knowles was a partner agent at 55 Places for close to 8 years in the Charlotte area. And Laura Brannock, who is a HECM for Purchase loan specialist with Longbridge Financial. Laura is not affiliated with 55 Places, but she has graciously agreed to tell us more about this program and how it could help our partner agents grow their business and offer their clients another option to get into the home that they love. This info session has been a long time in the making, well over a year. I originally spoke with Mary Lynn, like I said, about over a year ago, and I reached out to Mary Lynn, wanted to know what was trending in her market. And during our conversation, she mentioned she was having one of her best years. And when I asked, well, Mary Lynn, what are you doing and how are you doing it? She explained that 30% of her business was clients who are using the HECM for Purchase loan program. And I have to tell you, I almost fell out of my chair because as a partner agent myself, I knew about the HECM for Purchase loan program. I just couldn't speak intelligently enough about it. I remember I would try and present it to um, clients that it could potentially help, and it would, like, I would open my mouth and stupidity would roll out. So I asked Mary Lynn, what do you do? How do you do it when you're presenting it to our referrals? So, Mary Lynn, share with us. How did
Okay.
you present it? And go right ahead.
So I think your actual question, Jacqueline, was how do you sell it? And I said, I don't
Yes.
sell it. I get Laura to sell it. I just introduce Laura. So, but the truth of the matter is, it did change my business. It changed my life. It changed my clients' lives. And I love this program. It has made a huge difference. To date, it's still about 30% of my business, and it increased my business exponentially. So I had started in 2014 working for a 55 plus builder, and I was in sales and I was doing okay, but it was kind of a luxury builder, and a lot of folks would come in. They assumed because we were ranch homes or, smaller homes that the houses would be less expensive than they were. And so I was more often than I expected saying, we don't have anything in that price range. They just couldn't afford to buy what we were selling. So in comes Laura Brannock one day, and she sat down with me and explained how we could change these people's world and change my sales at the same time. And I have never looked back. So it made such a difference for me that I became the number one salesperson in the country for that builder. And I stayed with that position until I left 5 years later and joined 55 Places. And I still use this program every time I have a new client come in. And I do believe that it's not that difficult to introduce the product and not explain it. That's Laura's responsibility. All we have to do is let them know that there's an option for them. So the best thing I can say about it is that I got to change so many lives about it. There are options for home ownership. I gave them another whole opportunity. There's cash, and there's a traditional mortgage, and now there's the senior mortgage that's an FHA product for seniors. So then they always want to know what that is. Once I started with this HECM being integrated into my routine as a salesperson, a regular part of my sales, I noticed that not only people who had financial difficulties or had a smaller budget. The program didn't just apply to them, it applied to almost all of my clients. Very few people couldn't benefit from this. But I was most surprised to see that my financially savvy clients, they were really benefited. Every time I have ever had a financial planner or a financial analyst or somebody who deals with their money, maybe they're an investor, they've always done it. I've never had a client once that didn't do it. They can take an asset like a home and diversify the funds by not putting all the cash down. So a cash buyer can actually do really well with the money that they don't put down on the house. They can keep it, they can invest it, they can do all kinds of things. Um, One of my favorite illustrations of this was a couple that they sold their house in Charlotte. This was about 10 years ago, I think, Laura.
Yeah.
And they came in and they were at odds about where they wanted to go. Well, of course, I wanted to sell them a house. They had made $400,000 on the sale of their departure home, and they couldn't decide. The wife said she wanted to stay in Charlotte near the grandchildren. The husband said he wanted to go to the beach and fish because that was like his lifelong dream. So we talked about that HECM program. And at that time, using the matrix that we had at the time, at their ages, they only had to put 50% down on a house. So we found them a house that was exactly $400,000. They put 200,000 down on that house and had no house payment. So they had 200,000 left over. 100,000 went down on a condo at the beach. They had a really small mortgage there that they did have small payments on. They had another $100,000 and they invested it and they used the proceeds from that to make sure that they can cover the maintenance on both properties. I just thought that was brilliant. And after that, whenever I would bring up that conversation, other people started thinking about what they could do with their funds. How could they spend that money instead of putting it all in one house? I have neighbors here that are clients. Those neighbors did the HECM program, and I never see them. They're gone. They've gone to Honolulu in a year and a half. They've gone to Honolulu 3 times. They've walked the Camino Trail. They're going to Australia. They have 2 more cruises, and they've been on a cruise in a year and a half. They maybe been in their house 6 weeks, but they can travel. I also have clients who maybe want to have in-home healthcare for a spouse, or maybe they're on a smaller, maybe their budget's smaller because they have 2 Social Security payments and they're worried about what's going to happen to the spouse when one of those goes away. It doesn't matter anymore because there's no house payment. So Laura's going to go into the details of it, but it is life changing. It's been exciting to watch. As your business grows, your clients lists grow, because not only do these people get excited about it, they tell their friends. And because your other agents don't understand about this, they come to me, they call me. I want to know about this. Where can I use it? How can I use it? And I only have, before we get to Laura, the only thing that I tell these folks are a couple of things. I'll say you have 3 choices on your financing, and whichever one is right for you is the one we're going to go with. But you need to be a good informed buyer. Informed buyers make the best decisions and they're the happiest buyers. You can pay cash for your house, you can do a traditional mortgage, or you can look at this 62 plus senior FHA mortgage with me, and we can see if that works for you. After you've learned about it, then we can talk about the right way to go forward. I don't push them into anything, but I want them to know all of their options. So in order to get them to Laura, I asked 3 questions, and they're the same 3 questions that anybody would ask because they're the requirements for moving forward. Are you at least 62? Is this going to be your primary residence? And would you have the funds to put down on this house without taking out a second mortgage? Because y'all already know that no FHA mortgage is going to let you have a second loan on it. So if they can answer yes on those questions, that they're good to go. They only have to move once if they don't want to sell their house first and they have the down payment for the new house. They can put that down payment down. They can move into their house with no house payment and then get all settled in and put the other house on the market with you or with wherever they're coming from. So they can work it that way. We can have somebody who doesn't have the funds to buy a house near their children, but now they do because they have to put down less and there's no impact to them monthly. So when we sort of have that conversation, I do exactly the next thing. I say, let's call Laura Brannick and you can run your exact information because it's based on your birthday. Why don't we talk to her and see if it fits for you? I pick up the phone and I say, Laura, can you tell all of my colleagues about how this works? Laura, would you start?
Oh, certainly will. Thank you, Mary Lynn. Mary Lynn has had huge success with this program, and I will say the realtors that have embraced it have done very well with it. It's not a one and done deal for them. Once they start using it, they see how many of their clients can be impacted and how many more homes they can sell, how many more people they can help by utilizing the HECM for Purchase program. I want to start by saying HECM, HECM, stands for Home Equity Conversion Mortgage. And there are two types of home equity conversion mortgage, which is the purchase program that we're discussing. And also there's a refinance program of someone already owning their home and staying in there and using funds to remain in their home. Now you're going to hear from your clients, oh, this sounds like a reverse mortgage. You mean there's no payment? It's got to be a reverse mortgage. And a lot of times a reverse mortgage has a negative connotation to it because of a program that was years ago, like in the 60s and the 70s, before this became an FHA insured loan. This is a safe loan, and you hear that it sounds like a reverse mortgage. So this is different. This is not the same program you're thinking of. And we do kind of separate the traditional reverse, which is the refinance, from the purchase program. That's why we call it the HECM for purchase. You cannot say it's not a reverse mortgage because truly it is. It's just different than the traditional reverse. Um, so it is a reverse mortgage, but it's different than what they are thinking of. So we're purchasing a home. It's a safe loan. The other thing I hear is, does the bank own my home? Because they've heard, oh, the traditional reverse, oh, the bank takes your home. Well, that's never been the case, and it's not the case. No, the bank does not own the home. The borrower keeps title of the home. This is just a loan, similar to that of a traditional mortgage, except there's no principal and interest mortgage payment. They pay taxes, their homeowner's insurance, their HOA dues, and maintain the home like they normally would. This loan can be paid off. They can make payments. They can pay it off at any time. They can sell the house at any time. It is their home. The bank does not own the home. I have people ask me from time to time, can I pay on this loan or can I pay it off? Or if I win the lottery, can I pay it off? I'm like, yeah, the lottery sounds good because if you pay off your home, I'm your new best friend with the remaining funds and we're going to go travel. But yes, it can be paid on, paid off, but there is no required payment, no principal and interest. It's taxes, insurance, HOA dues, if that applies, maintaining the property like they normally would. The other thing I hear is, I don't want to leave my heirs with any debt. Well, they're not going to leave their heirs with any debt. The FHA insured, this is FHA insured product, and what that means is mortgage insurance that makes this program available is the protection not just for the borrower, but for the heirs and for the lender. And what that means is that in the event the house does not sell for enough to cover the loan balance, then mortgage insurance is going to step in and pay off the difference. The house is the only collateral for this loan, even if those parents have left their heirs money in other accounts, other real estate, it doesn't matter. The house is the only collateral for this loan. So if it's upside down, for example, the house sells for 400 and they owe 450, that additional 50,000 is going to be picked up by the mortgage insurance premium. Even if mom and dad have left them 500,000, 200,000, any type of money, other real estate, it does not have to be used to satisfy the debt on this house. Now, If the heirs want to keep the house, sure, they can keep it. They just pay off the loan and keep the house. Most of what I see, and I hear this from about 99% of the work with that people that I work with, their children, they don't want their home. They say, my kids have bigger homes, better homes, make more money than I ever did. They're not going to want my house at the end of the day, and they're certainly not going to want my brown furniture. So the kids are going to get the house, they're going to sell it, pay off the loan, and they're going to take those net proceeds and go do whatever they want to with it. That is the biggest, I mean, that's the conversation my clients have with me is my kids don't want my house. At the end of the day, the clients say, well, if it's upside down, mortgage insurance takes care of it. Or if my kids want it, they can pay it off and keep it. So
So
that's
Laura, I have a quick question for
sure.
you.
Yep.
Who does this program not work for?
Okay. So I would not, and I've had this come up before, Jacqueline. I've had it come up is you've got parents that have an adult child living with them, and that adult child has no intention or cannot possibly find, afford to live by themselves or purchase their own home. So when the parents would no longer live in the house, the loan becomes due. So if that child is not able to pay off the debt, or they're concerned that that child may not be 62 or older when they pass away and would not be able to refinance into their own HECM, I would not recommend it. And when I hear a situation like that, and people say, "Well, my child lives with me," or "My sister lives with me," any relative, I said, "Okay, so let's look at this. If you pass away," and this has come up, if you pass away, would is there life insurance that would pay off this loan? Do they want to remain in the home? Is there any backup if you pass away, and where would they live? Here, or would they be able to find their own place? And I've had it come back, no, we've got that protected. This child, we've set up a trust fund. They would be fine. We pass away, they can pay off the loan and remain in the house. Or I did have a situation recently. It was a brother and sister, and the sister would have been fine. But if she passed away first, the brother would not have been able to remain in the house. So I'm like, this is not, and they, and I explained several times, this is what will happen. You need to make sure that if you're going to stay there, you have to be able to satisfy the debt or refinance in your own name. So that's the number one thing, I guess, Jacqueline, that's not, it would not be suitable for a situation like that.
Thank you.
And
Yes,
Laura, you
ma'am.
would think that that wouldn't make a difference because most of our clients are in these 55 plus communities. That's this group that we're talking to. But can you tell us about how the HECM loan works for, does it have to be just in a 55 plus community?
It does not have to be in just a 55 plus community. Now, this program got its start, it got its big lift kickoff in 55 plus communities for obvious reasons. Most people in there are 62 and older. So that's where the HECM program got its big lift. But no, it can be a regular neighborhood, it can be a townhouse, it can be a condo. If it is a condo, it has to be an FHA approved condo. And if it's not FHA approved and your client is really wanting to live there, I can look into getting it FHA approved, the whole complex, or do a single unit approval. However, I always look first. There's a HUD website for FHA approved condos that everyone needs to look at or call me. My client wants to buy this condo. I need to know if it's FHA approved. I can find out real quick if it's FHA approved. If it's not and they want to move forward, then I can work with the FHA, with a homeowners association, excuse me, to get the documents needed to submit to see if we can get it FHA approved. I
And,
have a I have a situation right now that I'm going to try to get a single unit condo approved, FHA approved for a client that really wants to purchase there.
Well, for the
So,
record, I've never had one client that wasn't in a 55 plus community that did it. So there, most of my business is in these 55 communities, like y'all's probably, but
yeah.
I've never had one that didn't. But it is appealing to them to hear that they're not locked in, that they get to choose their home, choose their community. They're not
Mhm.
locked into just a certain kind of community. So
Right. And that's a great
as
question,
a
Mary
client,
Lynn, because I do have people that will ask me, well, do I have to buy in a 55 plus community using this loan? To use the loan? I'm like, no, no, you don't. That's where it got its big lift, but you don't
yeah,
have to purchase in a 55 plus community. It just, primary residence, um, FHA approved condo, townhouse, and they're
yeah,
they're good to go.
yeah.
So,
And some of our 55 plus communities have condos in them.
right, they sure do. Actually, the one I'm working on right now, trying to get it FHA approved, is in a 55 plus community. So,
Nice,
yes, yes.
nice.
So again, it's got to be primary residence, eligible property. One borrower has to be at least 62. So if there is a borrower that's 62 and one that's 55, for example, the calculation is going to go by the date of birth of the younger of the two. So what that means is they would have to bring more money to closing. One's 75 and one's 65. It's going to go by the date of the birth of the 65-year-old. And that's due to life expectancy because keep in mind, there is not a principal and interest payment on this mortgage. So interest does accrue throughout the life of the loan. So it's based on life expectancy. So that's why they go by the younger of the two if it's a couple. Um, I would like to show you a matrix. I believe you all possibly have the matrix, purchase matrix, but I'm going to bring it up here and show you. Let's see here.
Y'all, this is the secret weapon. When they see what the value of the house is versus what they bring, that's when it hits home about how they can change their life with this. It's very cool.
Okay, can you see it?
Yes.
Great. Success. All right.
All I
So
see is Laura Brannick sharing her screen. There we go.
does everybody see my screen with the matrix?
Yep, we can see it.
Okay, good, good. All righty. So, well, let's take a look. Let's take a look at a $600,000 purchase. So you've got a client that comes to you and they have $400,000. Well, $400,000 in my book is a lot of money, but they cannot find what they want for that $400,000. They don't want a monthly mortgage payment. So that's one reason they're paying cash for it. So they don't have a monthly mortgage payment. Well, that client, the youngest of the two, is 70 years old. So a 70-year-old can purchase a $600,000 house for approximately $385,000. Now, these figures we automatically calculate closing cost in with our lump sum down. That's an automatic calculation for the bar. That way they have an idea of all in at closing instead of us just quoting, well, here's the loan amount and here's this separate and this separate. We do a calculation all in. We do get a really close estimate on what the closing cost would be, and it's part of the calculation. So you can see here, a $600,000 house. Now, how many clients do you have that have $400,000 but have not been able to find what they want? I mean, maybe you can find them something for 450. Well, they would even have more money left over. Let's say you've got someone that wants to purchase a $750,000 house. You look down, age 62 years old, they would need approximately 522. I mean, there's significant, you know, the benefit is significant for someone to use the program. I mean, if $300,000 house, and you've got someone that has 200,000, they're 70. You can show people how they can get into the house of their dreams with less money down and on many, many times they hold on to additional money in their pocket because they're finding what they want for less than what they actually have. They're holding on to net proceeds or cash in their money market or in their retirement funds. This is something also, if this may work, and while somebody uses money from their investments or savings, if they haven't sold their departure home yet and don't have the net proceeds from that, maybe they have funds elsewhere that they can use to go ahead and purchase their home while they have their other property on the market. So this has helped a lot of people make that move one time instead of twice because they have other funds to access instead of having to rely on net proceeds.
And it's also helped some of my buyers, even in the last couple of years with these interest rates that are higher and they're worried about selling that departure home. It allows them to go ahead and move forward because they don't have a house payment on the new house.
Right.
So their expenses are nominally changed, but they can still put that house on the market and be done with it and start their new life in their new house. And it has really made a difference for me being able to help my seniors move forward and not just sit in that house waiting for it to sell before they can make a decision about where they want to go. It has really helped with that a lot. But well, Laura, will you mention about your client that had very limited funds and could not find a place? I think you were working with a realtor or something about that.
Oh, yeah. Yes, I will. Now, before I do that, I just want everybody to kind of think about who they have right now that they have shown properties to, that someone that may have, they may have $300,000 and you can't find them a house, or they may have 400. Will this work? Think about it. Says, are they 62? Is it at least one if it's a couple, are at least one 62 or older? And would you be able to help them if they, one, didn't have a principal and interest mortgage payment, and two, were able to, if they had only enough money to purchase X amount of house, would this help them? And I think you could probably go through your database and think of people and maybe introduce this and send them a copy of the matrix, or just have the conversation with them, or, I'll be happy to have the conversation with them. So I'm going to take the matrix down now, unless somebody, Jacqueline, do you want me to leave it up for a little longer? You want me to go ahead and take it out?
Go ahead and take it down.
Okay.
We can
All
always
right.
pull it
There we
back
go.
up again
Okay.
too.
All right. So I call it my Linda Allred story, and this is the person that Mary Lynn's referring to, because this was such a great, great story, and I've told it several times. I was calling on some realtors about the purchase program, just out visiting one day, and I thought, well, I'll just stop by Linda's office. Was a realtor. She was the only one in her office. So I'll stop by there and talk to her a little bit and give her information about the purchase program. Well, I walked in with my matrix and was showing it to her, and she had just come in from showing houses to a lady, and she's like, "Where were you this morning?" I'm like, "Well, I was out and about talking to other realtors." She says, "No." She says, "I've been out showing a client houses. She only has $130,000 to work with, and there is nothing out there." She says, "I've looked at townhouses," and she says, "What's out there is nothing that she would live, nowhere where she would want to live that would be safe for her to live." So the very next day, Linda connected me with her client. I kind of did a quick pre-approval, ran some credit, verified her funds to close, what she would have. Linda went out and showed her houses. They wrote a contract for a $170,000 townhouse, and the lady needed. So keep in mind, she had 130. So she needed
Laura, I can't. Are you freezing?
$1,000 down. And so it's that $100,000,
Hey, Laura, you're cutting in and out.
everybody's freezing.
I'm not freezing. Are you freezing,
I'm not
Jacqueline?
freezing. No, I think, Laura, do you have a good connection, a good Wi-Fi signal?
Okay, hold on just a second.
While
Is
you're
that
checking, I'll just summarize for you because I've heard this story earlier today. The
Thanks,
client
Brandon.
needed to only put $95,000 down and was able to buy a $175,000 or $170,000 condo and was able to keep the balance between her 130 that she had in cash and the 95,000 that she put down. So she actually left the office with money in her pocket. So and
can
a new
y'all see?
there you are.
Okay, a little bit
Okay.
different, but okay. So
Okay.
I just heard Mary Lynn, you just finished telling
So,
the story. So she,
sorry.
she had $35,000 left, and she was thrilled. So that was a great story. And this particular agent, Linda Allred, continued within 16 months. She did 5 HECM for purchases. She was able to help 5 more clients with this program. She just fell in love with it, and it worked for 5 more clients, and she has since retired, but I see her from time to time and we talk about the people we helped, and she still refers business to me even though she's not in the business because she fell in love with the program, and she
Laura,
would have done it. Huh?
would you tell us a little bit as agents? We want to know things like, can you still close us about the same length of time? But what's
Oh
the
yeah.
application process? How long, quickly can we get, if we call you, how quickly can we move on helping them, our clients, buy a house? How quickly is
Well,
that
the
pre-approval
first
process?
thing that when someone calls me, it's let's do a pre-approval. A pre-approval does not take very long. I can usually, if someone submits me the documents needed, which is verification of funds to close, their, ID showing how old they are, and, I've run credit, but I get documents, I submit a pre-approval. I can generally have a pre-approval in less than 24 hours. Our pre-approval is not a letter that I am going to just generate myself. Our pre-approvals are actually go to a underwriter to review. So it's a pre-approval letter that comes
Oh,
from underwriting, meaning we have looked at credit, verified income, verified assets. And so we issue a pre-approval letter, and they go find a house, and we write you write an offer on the house, and we start the application, and the application process is very similar to that of a conventional mortgage. And a lot of times, since I have just done a pre-approval, like I did a pre-approval 3 weeks ago for a client, and he found a house immediately. Well, those documents from the pre-approval are still current. So I am like 3 steps ahead. So I take his application. All I need to do is submit the application and order an appraisal because we just did a very thorough pre-approval. So I didn't need any additional documents from him. Sometimes I'll have to request additional documentation, and that's based on how old were those investment statements, or were we waiting on a house to sell and we had to verify net proceeds? So there's different circumstances, but the process generally is pretty quick once we've done the pre-approval and we get the contract and I take the application.
can you tell us a little bit about how you take that application?
Oh,
My
yes.
clients are so averse to going online and having to fill all that in. They're so worried about their information.
Right. Well, being this program is for people 62 and older, it's a little different than a conventional loan officer taking applications and having someone go online to fill out an application. Um, I have the conversation. I do by phone applications. And if someone is within 3.5 to 4 hour radius of me, I'll be more than happy to go sit face to face. So that's, I do that frequently. But by phone applications, I'll get all the documentation. I can send the application to them FedEx for them to sign, or I can send it to them like a DocuSign or e-sign if they want it that way. I do both. If I send it FedEx, I've got everything highlighted where they need to sign. I also send a return label with that FedEx package to make it easy for them to take that application to their local FedEx office and send it back to me along with the required documents needed. So it's being that I have done nothing but the HECM program, be it the traditional HECM or the purchase program since 2005, that's a pretty, what's it called, a well-oiled machine or process that I do with clients
Yeah.
where it comes to the application. So, um,
So
respond.
I think we've got some questions from some partner agents. Mackenzie, can you allow some of our partner agents to be unmuted? I know I saw a question from Rochelle Fennel. Laura, she asked, can you offer this program in other states? Are you able to do this in other states besides the state North Carolina?
Yes, yes, I am licensed in 12 states. However, our company is licensed in other states. So if it's a situation that I cannot help, I can be in the middle in either one. I get licensed in states when someone needs me. That's why I have 12. That's why I'm licensed in 12 states. So it's possible I could be licensed in that state if it's a state that I'm not licensed in, or we have our company is licensed in all states, so I can still help. It would just go through another loan officer that is licensed in that state.
Carrie Augustino asks, will there be an info sheet that we can share with our clients explaining the structure of the loan?
The structure of the loan. I have a buyer's guide that I can supply everyone with. That if you're talking about the process, as in, the pre-approval, the application process, is that what
How
you're
it
referring?
works.
Yeah, she's asking fees, etc. Um, if I can just make a comment, I would, um, our partner agents are not loan specialists.
Right.
Right,
You definitely want to get them in touch, with a loan specialist, and they can discuss the fees for any loan. Um,
yeah.
but
That's
yeah,
Yeah,
true.
and fees
I
vary
love
by
that
state.
matrix. I love that matrix that you use. It's very simple to understand. It doesn't discuss any fees, but it does explain, what their purchasing power could be.
Right,
Yeah.
right. And the matrix is the number one because that does have, um, that includes closing costs, because closing costs and the fees are going to vary by state because
Right.
you've got different taxes, you've got different title fees. So they are going to vary. Now, the matrix, is we are generous as in overestimating some on the matrix because we know like California has higher fees than North Carolina does. So we take that into consideration when we generate a matrix.
Okay.
And those
Um,
are updated like quarterly, I think.
They are, yes. We have updated quarterly. We do have, the matrix, I can email, well, everybody has the matrix, or they can be emailed to the borrowers. If someone wants, I can have some actually printed and have them sent to the partner agents if they want to include them in their packet. I also have a trifold, a purchase little trifold that's good for clients as well. And we have a book that is being updated that we'll have probably within the next 3 weeks. It's called a buyer's guide. And it's several pages of a little book, and I love it. It's a good read, it's an easy read, and it tells more about the process.
are you able to provide that electronically?
The
The buyer's
buyer's
guide.
guide,
I
I
just
can.
Rochelle Fennel asked, would love a copy of the buyer's guide for myself to get a better understanding. Just thinking that if we could get that out to any of the partner agents that are interested in it, you could
Yes,
send
it
an
should
email.
be. Yeah, it's being updated right now because we update as the figures in it as rates change and stuff. So it's being updated, but as soon as we have this updated version, which should be shortly, I know it's been in compliance now, so I can certainly get that and it can be distributed.
Okay,
Um,
thanks.
yeah.
And I know Kim Paran, you have a question. I believe you're unmuted, Kim. You can go ahead and ask the question.
Thanks. So if I have somebody, I'm just trying to understand the whole process. So if I have somebody that wants to sell their home and buy something else, so say their home is worth 700,000, they want to buy something that's 300,000. They would have to put a certain amount down on that $300,000 home to get the HECM before their house sells. Is that correct?
They don't have to do it before the house sells, but if they want to buy a house before they sell their departure home, then like any other way, they'd have to put some money down. But
Right, but it
yes,
wouldn't
they would
have
put
to
a
be
percentage
that.
of that 300 down.
So if it was 300,000, it would just be like a regular um offer that we put in or contract. Because I was looking at that matrix sheet and it's showing, $100,000 or something if it's a $300,000 home. I think that's where I was getting confused.
Right, so that's what they would have to put down. Yeah, based on their age, and the younger of the two is how much they would have to put down to purchase that $300,000 house. And our next matrix that we have is going to have a lower price range. I think we're going to start at 200,000 on our next matrix, which will be out next because we do them quarterly, which will be out next week. And I can get you that, Jacqueline, to distribute if you'd like. But yeah, so it's just a portion. So if they have a house that's, 700 and they're wanting to go ahead and purchase a house that's 300, and this is going to be the $300,000 house is going to be their primary residence, then they're
Yes.
really, they're able to move without selling. Plus they're
Oh,
getting into a house for a whole lot less than the 300,000.
right. And then
So
when their house sells, they can pay that HECM off with their proceeds.
they can, or they can hold on to their money and go
Okay.
travel or hold on it for future use, in-home care, whatever they may have, go play with grandkids, whatever the situation may be.
Okay.
Laura,
So it has to be that it's for somebody that has that extra money though. So if it's somebody who doesn't have that extra money to put down, this would not be a good program for them.
Well, they'd
Um,
have to sell their house first.
Right. Yeah.
Yeah,
Exactly.
and it has to be, they can have other real estate. The HECM has to be on their primary residence. And we
Okay.
have people all the time that have houses elsewhere, but they're moving, they want a primary residence somewhere else, and that's the HECM is on the primary residence.
Okay. Got it. Thank you.
I have had, bringing that up, I have had people utilize this program 3 different times. Purchased a house in North Carolina using the HECM purchase, decided to move 2 years later to Wilmington, North Carolina. So they sold the house, took the net proceeds, which they were in Denver, took the net proceeds from there to purchase the house in Wilmington, didn't like it there. So they sold that house, took the net proceeds, and purchased in Denver, Colorado. So, I mean, the house is, yes, interest accrues on the amount of money we lend, but the property values are increasing as well. So they're still coming out with a considerable amount of net proceeds. Sometimes, well, these people actually came out with more than what they put down on the house because of the increase in value. But it's not a one and done deal. They can continue to use it. I mean, had the same situation with 2 Wilmington properties, and then they moved to Massachusetts. So it's like I said, I'm licensed in 12 states because my people keep moving. So, which is great. I mean, it's great. That's the phone call I get sometimes. It's like, Laura, are you licensed in, this was for real, Laura, are you licensed in Massachusetts? And I had already done 2 loans for these people where they'd bought and sold. And I said, don't tell me you're moving again. And it's like, well, yeah, we are. I was like, okay, well, just give me about 24 hours and I'll be licensed in Massachusetts. So,
Laura, Curtis Scott has a question. What is the average rate and any points for the program?
okay, we do not have points. The rates right now, and of course, that depends on the loan amount, but our average rate right now is six. Some I saw 5 3/4, but say 5 3/4 to about 6 3/4. That's an adjustable rate. We do have a fixed rate. However, the fixed rate program right now requires more money down. And I showed the fixed rate and I showed the adjustable rate. And the clients choose the adjustable because the less money down. They're like, we don't, we want to put the least amount of money down as possible. I have not done a fixed rate probably in 6 years because People choose, oh, I want to get in the house with this little money down. When they find out about it, it's like, no, I want to hold on to money. So,
Any other questions from our partner agents?
This is Robert Ramirez. Laura, I've got a question. I have a client moving from Texas. She has to sell her house. It's a $310,000 house, about what she expects to get out of it. And finding something in Williamsburg, Virginia has been very difficult. So this sounds like that would work for them. However, the people who used to do the HECM mortgages for me aren't around anymore, and I don't have someone that does them here.
I'm sorry.
How
No, you're
difficult
not.
is it from selling a house to moving into another house? It can be done just like any other mortgage. But is there a time frame for them having to come up with the money, or is it just at closing, just like every other mortgage?
Well, it's at close. Well, we verified a couple of days. We want to make sure a couple of days prior to closing. So if they're selling a departure home, what we ask for, and I am licensed in Virginia, by the way, so I'd love to help you. What we ask for is verifying, one, are they going to have those net proceeds from the sale of their departure home? So we kind of get the net sheet to show that this is what the house is selling for, and here's how much they're going to have. And then we do have to verify those funds. Even if it's the day, if they're selling, if this is a back-to-back transaction and they're selling one day and purchasing the very same day, then we just have to show, we get the settlement statement and we have to show those funds being wired from that departure home for their new purchase.
Texas or
Like,
Virginia, it'd have to be at least 3 days.
well, 3 days. Yeah. Yeah. But I mean, that works out well. I mean, I've had several back-to-back transactions, closing in the morning on one and in the afternoon on the other. And we're
Thank you.
not,
How can I
because of
get
this
that?
structure of this loan, we don't follow the TRID. We're not required for the TRID guideline. However, we like things approved, um, settlement statements out for everybody to review and all of that as quickly as possible after a loan is approved and we're ready to close.
Absolutely. Thank you.
Uh-huh.
Curtis Scott had just a few other questions. Can you use this program as a bridge loan? And since this is an FHA, is there a funding fee?
As a bridge loan, I'm not sure I follow. We don't do bridge loans. They can do this loan and then pay it off at any time. So is that
So Laura, my question was, I've had some clients coming in the situation you talked about where they have properties that they're selling in other areas,
uh-huh,
yet they're utilizing the money. So they have properties that have very low balances or no balances at all, and they're downsizing, but they want to utilize the cash from that house in order to buy the new house. So I've set them up before doing a bridge loan. That's a standard financing. It's a short-term financing that
right.
is for 6 months where they pull money out of their current house and then it is utilized to purchase the new house in cash.
Right, right. So on a HECM program, the funds cannot be borrowed. So they would be borrowing from their other
Okay, so let
property.
me let me ask it in this way. If I set somebody up with a program like this on the purchase of a new home, and then they sell. I'm in Northern Virginia, so they buy a house here in Northern Virginia using the HECM program, and then they sell their house in whatever, Indiana, wherever else. They come back 30, 60 days, 90 days later. There's no penalty or hindrance to them paying off that HECM loan 30, 60, 90 days later.
That's correct. They can pay it
Okay.
off or any time, or they can just hold on to that money from the sale of that property.
Okay.
Yeah, yeah, they can do that. I mean, I've had when it comes down to people say, well, I might want to pay it off. I'm like, well, you can certainly do that. And a lot of times they say, well, the program works well. I think I'll just hold on to my cash. But if they choose to pay it off, absolutely they can pay it off.
So this is a good option for bridge loans, which I don't know I'm assuming the rest of the guys on the call also encounter bridge loans as well with the situations of people moving into 55 plus neighborhoods. My second question I had on here, and then this is all I got, is this is an FHA loan, so is there a 1.75 funding fee that goes on to the loan as well?
We don't have a funding fee.
Or FHA fee?
There's
Oh,
a what we have is the mortgage insurance premium that's an automatic calculation into the amount that they bring to closing. So on that matrix you've got includes an estimated closing cost, which are standard closing cost for
Anybody.
appraisal, title, all the credit reports,
so
the insurance,
FHA,
but you have a FHA, you have a mortgage insurance premium fee
okay,
that
and a
is
monthly,
included in the upfront amount.
and a monthly?
The ongoing monthly throughout the life of the loan is a
Okay,
0.5%.
so,
And that's not something that they are paying. That is
right,
accrual that comes due at the end. That's part of the loan balance at the end of
right.
the day when they've either, sold the house or gone out toes up. It's paid then. So,
Okay, so this program is set up like a standard FHA.
and I guess I guess the funding fee and the mortgage insurance premium fee are a little bit different, but that is included in the lump sum down. Yes.
Thank you.
You're welcome.
Rochelle has her hand up.
Thank you, Laura and Mary. This has been very informative, and I think you just answered our question. So basically, in our eyes, this is really a, a version of FHA for seniors.
Yes.
Okay.
Yeah.
So I have, current clients right now, 50 from 55 places, and this is our scenario. If you don't mind, I just want to run through just to make sure I understand. So the family wants to sell the grandmother's home.
Mhm.
The grandmother's home is probably worth about 500,000. She
Okay.
she wants to spend as little as possible, and I'm in New Jersey, so that's almost impossible. She's looking for something for around 250. I don't know if
Hmm.
that's going to be doable, but basically the loan that she would get from you would be around 250, correct? Is that what we're saying? She would look for an FHA loan or HECM loan for the price of the home that she wants to currently buy, right?
Um, no, she would be looking, if she wants to purchase a home for 250,
Mm.
depending on her age. And if you take a look at the matrix, for example, let's see here. How old is she? Do you know?
Oh, no, I have a feeling she's a little bit like probably more like 70.
Okay, well, let's say she's 70 and she's got 250.
Mm.
So I'm looking at the matrix. 195 for a $300,000 house, she would need about 195,000. So 400, 375, 390. If she's got 250, then she's going to be able to buy a house closer to 400,000 with
Oh,
her
well, she
250.
wants to keep it down though. She wants she wants the 250 home. So I mean, they're trying to avoid having to sell and buy and, it's one of those situations. So I was thinking maybe we could use it kind of like what I forget who it was, maybe Curtis, kind of like a bridge loan. Have have them take the loan out on the smaller amount and then sell the property after the fact. Am I understanding this correctly?
So you found her a house for 250,000, Rochelle? You
Oh,
should be
no.
like,
No.
I was like, you need a crown.
I know, no, no. I'm just using that as an example. That's like in a perfect world for them. It's probably going to be like more like 350, but I just to use like basic numbers though. That's what I was kind of wondering. Um, and the other thing too, you had mentioned about having an adult child there. She does have an adult daughter that lives in the home.
Right.
And so she would either, like you said, she would either have to be able to pay off the loan or refinance, but she's not going to be able to because she would have to be able to repay the loan, right? Because she's not 62. So
Right.
this
If
may not
something,
be a fit for them then.
yeah. So if something, or if the mother has life insurance and the daughter's the beneficiary of the life insurance, is it enough to cover the loan?
Okay.
At the end of the day, when mom, if mom would pass away, that's one thing to look at, because I have had that situation before. It's like, well, the life insurance goes to our daughter, so if something happens, then she's covered.
Right.
Yeah, and
Well, also you've got, if you buy a 250 house and she's buying that house before her house sells, she's selling a house for $500,000, put 250 or whatever the balance of that mortgage is, put it aside for that daughter and she can
yeah,
buy that house.
I see what
yep.
you're
Put it aside to use to pay off the loan, but a
Yes.
250 house, I mean, she may be able to get into that $250,000 house for, $150,000.
saying. Okay.
So she'd be holding on to some money.
Gotcha. Thank you. Are you
Mhm.
licensed in New Jersey?
Not in New Jersey, but I have someone that is exceptional in New Jersey, so that we can work together with.
Thank you.
Mhm.
Laura, Ed Sadler is interested in you sharing the screen share of the matrix again.
Okay.
And then let me just share with the partner agents a copy and a copy of this matrix was actually an attachment to the original email that went out to everybody to register for this information session. But we can send it out again too.
Okay, so we'll share. All right. Can you see it?
Yes.
Okay, perfect. All righty. So you have a question about the matrix, Ed?
I don't have a question as such. It was easier to follow everyone else's questions about house prices and how much down with this in front of us.
Oh, okay. Gotcha.
And,
I
and,
just,
and just a little feedback. As soon as I got the invitation for this presentation, I signed up as a way to increase income. And when I dug down on HECM, the first thing that came to mind was first mortgage, and I wished I hadn't signed up. And I really wanted to pull the plug on participation, but this has been excellent. And if you can convince me, I'm sure that my clients will understand it quickly.
well, thank you. Thank you. It is a different program. And yes, that is why I say one of the top things I hear from clients, oh, this sounds like a reverse mortgage. Oh, you're selling snake oil. What's the catch? I mean,
Yeah,
believe me, I have heard it all. I've had people just, oh, that's terrible. I'm like, so why is it terrible? I don't know, but my aunt told me it was bad. I'm like, well, what did she know about it? Well, I don't know, but I just heard it was bad. So,
right,
just like any other loan, you have to pay your taxes, or somebody's going to come knock on your door
right.
eventually if you don't pay your property taxes. Homeowners insurance, you've got to pay that. HOA dues, you have to pay that. But I mean, I have had people be in presentations that had paid cash for a house. And actually, I had one gentleman that came to one of my presentations, and he had paid cash for his house of about $450,000. And he came with a friend, and he was actually angry that he didn't know about the program. And at the end of towards the end of the presentation, when people were talking, he's like, why didn't I know about this program when I bought my house? I'm like, well, sir, I wasn't here at that time. I wasn't doing presentations. It was a community at 55 plus community that had invited me in to speak and do this presentation. So it's kind of like, we can talk afterwards if you want some of your money back. And that's where the traditional reverse comes in. Somebody had paid cash for their house, they need some of their money back. So, that's the traditional, but it is a great program, and you introduce it, and don't let people get scared when they say, oh, it sounds like a reverse. It's not the same. Yes, it's a reverse, but it's not the same as what they're thinking about, just like it's not the same as what you initially thought about. So,
So if you guys can just get Laura on the phone, she will tell your clients if they are not a good fit for this. She's told many a person that I thought was going to be working, and she found her something and it just wasn't going to work. And she's also passed on clients where she thought they would do better either getting a traditional mortgage or paying cash for a house for whatever reason. So, You don't have to sell it. You don't have to explain it. You just have to talk about that one of their three options and that a good buyer is an educated buyer. And then get on the phone with her and she'll take it from there and she keeps you totally informed.
This has been great. Y'all, email me, call me, text me. Be more than happy to answer any questions, run estimates for you if you've got someone you're working with. I do need date of birth of the youngest. So if it's a couple, date of birth of the younger of the two, and I'll be glad to run estimates for you.
Awesome. All right. Thank you all again for your time.
Thank you. Thank you, Jacqueline. Appreciate it.